Well, good morning. I am Jagender Rana. Topic for the discussion today is fraud risk mitigation. Fraud risk mitigation. The general insurance industry has been plagued with fraudulent claims and policies for a long time. The General Insurance Council is working at reducing fraud in the industry. To this end, many data sharing and experience sharing platforms have been enabled. It is believed that if the companies work together, it will be easier to identify and thereafter stem the frauds. So the fraud risk mitigation project is a set of small actions that the industry is taking in order to prevent, identify, prove, and then take appropriate action on fraudsters. With an aim to promote better fraud risk management system and framework in regulated entities, on 15 July 2024, the Reserve Bank of India has issued 3 revised master directions on fraud risk management, which are applicable to banks, non-banking financial companies, NBFCs, including housing finance companies, and cooperative banks. All 3 master directions are together referred to as revised MD. Now, in the year 2024, Indian businesses found themselves navigating a regulatory landscape rife with compliance challenges that went on to reshape operations and set tone for the future. So from data privacy laws to ESG reporting standards, AI adoption challenges and managing corruption, organizations had to brace themselves to tackle unprecedented regulatory scrutiny. As we begin in a new year, it is time to take stock of the regulatory compliance, some challenges that compliance faced in the year past, assess its impact and the learning gleaned in ensuring implementation of the compliance risk mitigation strategies, along with seeking a peak of the prevailing trends that will continue to redefine the compliance turf in 2025. So here are some of the new regulations and stricter enforcement mandates that as companies aspiring to strengthen their compliance functions. The first one is data protection and privacy. Data protection and privacy. So the Digital Personal Data Protection Bill, which is set to revolutionize the way personal data is handled in India, has been a topic of much discussions and preparations among businesses. However, without a finalized set of rules, companies have been in a preparatory limbo, aware that significant changes are on the horizon but uncertain about the specifics of compliance requirements. And then comes the artificial intelligence. Because the rapid adoption of artificial intelligence across sections has necessitated a careful approach to regulations balance safety and innovation. Several countries are currently in the process of navigating complexities of formulating regulations for AI technology, aiming to promote its safe adoption and responsible use. Then the anti-money laundering and counter-terrorism financing. The Financial Action Task Force has kept organizations on their toes with evolving guidelines on AML and CTF compliance. The Reserve Bank of India and the Enforcement Directorate have tightened regulations requiring businesses to enhance their due diligence processes and report suspicious transactions. The increased scrutiny has led to a greater need for compliance professionals and advanced analytical tools to monitor financial transactions. So while 2024 has been a challenging year for regulatory compliance in India, it has also been a year of learning and adaptation. Businesses that continues to prioritize compliance and harness the might of technology to ensure meeting reporting standards will be well positioned for success in coming years. The applicability of the regulations is expanded from the scheduled commercial banks and select financial institutions to include regional rural banks and local area banks, corresponding new banks, Exim banks, NABARD, national banks, etc. Because this control on frauds is a very difficult process. Even the regulatory bodies failed to control the frauds in the insurance industry today. So unless there is a system, the frauds cannot be controlled. The frauds cannot be controlled. Moreover, in insurance industry, this fraud is increasing year on year basis. Every year, frauds are increasing. And provisions under the IRDAI Corporate Governance for Insurance Regulation 2024, it establishes a system to detect and prevent fraud, protecting the financial well-being of insurance and policyholders. So this protects policyholders by addressing fraud risk, ensuring customer trust and safeguarding their interests. And that is necessary today. This is the need of the hour, because unless the frauds are controlled, things cannot get streamlined. Section 34 of the Insurance Act 1938 gives powers to IRDA to issue directions for the proper conduct of the companies. That means fraud in insurance can be simple. For example, lying about claims, or complex, for example, organized schemes involving many people. So regardless of the type, fraud harms the insurance industry's trust and finances. So understanding these frauds helps fight them better. So the types or classification of insurance frauds prevailing in India are: first, internal frauds. This type of fraud is done by an insurer's own staff, for example, employees or management, alone or with others against insurer, policyholders, customers or beneficiaries. It includes stealing money or company assets, using unauthorized access to sensitive data or resources, so forging documents or collaborating with fake claimants. Second one is distribution channel frauds. This type of fraud done by agents, brokers, or other sales channels, either alone or with others against insurers, policyholders, customers, and beneficiaries. Some examples of these are lying about policy details, stealing or misusing premiums paid by customers, fake documents or selling fake insurance policies, insuring non-existent individuals, or inflating claims. Third one is policyholder or claim fraud. Policyholder or claims fraud. So this type of fraud done by policyholders or claimants, either alone or with others against insurers, policyholders, customers, or beneficiaries. That includes lying to get a policy or claim approved, faking or altering documents, and impersonating others. And the last one is external fraud. Means it is done by outsiders like external parties, vendors, or service providers against insurers, policyholders, customers, or beneficiaries. It includes creating fake reports for fraudulent claims, charging for services not provided, for example, inflated repair bills, and selling fake insurance policies. So the risk governance framework has been simplified now to avoid monetary losses and safeguard the insurer's reputation. Managing fraud risk calls for a methodical and transparent strategy. Insurers can protect their assets, adhere to legal requirements, and preserve stakeholders and policyholders' trust by implementing a robust fraud risk governance framework that guarantee accountability and transparency. In order to combat fraud proactively and promote long-term success, insurers need to have a well-documented strategy. So the chairperson, the Insurers Risk Management Committee, RMC, the managing directors, chief executive officers, and the audit committee are in charge of keeping an eye on controlling fraud risk. As far as the roles of insurer is concerned, a fraud risk governance structure must be established by each insurer in order to stop identify and handle insurance fraud. That means anti-fraud policy is there. Insurers need a board-approved anti-fraud policy that clearly explains how fraud will be prevented, detected, monitored, and reported. So this policy must aim for zero tolerance for fraud and include the following: adjust to the insurer's business size, complexity, and technology use, strong systems in early detection and handling fraud risk, appoint specific officers to report fraud to law enforcement and coordinate them in fraud case resolution. Then disciplinary action on those found involved in fraud as well as those non-compliant with fraud policies. And incorporate fraud prevention in online transactions. Provide appropriate resources and tools for the fraud monitoring unit. Remove those involved in fraud from sensitive positions. Define roles and the levels of authority to effectively identify fraud. The anti-fraud policy should be reviewed and updated at least once a year, considering new risk experiences and trends. So this fraud monitoring unit is a separate team independent of the internal audit that helps the fraud monitoring committee that is responsible for preventing, detecting, investigating, and reporting fraud. So risk identification and measurement is necessary now because the annual risk assessment, insurers must conduct a yearly review to identify areas vulnerable to fraud and submit the findings to the board. Insurers should use past trends and RFIs for this assessment. Then red flag indicators. Red flag indicators are warning signs of potential fraud. Insurers must regularly update and integrate red flag indicators into their operations for effective directions. So what can be the red flag indicators? This can include complete or inconsistent information, unusual coverage request, backdated policies, etc. Then the most important part is risk control and mitigation. So in order to ensure fraud risk identified as part of the annual comprehensive risk assessment and mitigated, insurers shall have in place take appropriate measures to deter, prevent, monitor, investigate and report fraud in respect to the following. Internal fraud. In terms of this fraud, it is necessary to have background checks and job rotation for employees, also secure whistleblower mechanism. To report fraud confidentiality, it is essential to have strict access control for sensitive systems and transactions. The distribution channel fraud. In terms of this fraud, it is necessary to have background checks and agents and adherence to fraud control systems. Systems to track unusual policy cancellations and reissuance and customer complaints against agents are closely monitored. Policyholder claim fraud. It is necessary to educate customers about the consequences of fraud, ensure robust underwriting and claims verification, and use advanced technology to detect fraudulent patterns. And for external fraud, it is important to have regular due diligence and audits of vendors and service providers and monitors compliance with concrete or with contracts and agreements. So risk monitoring and review is required because every insurer maintains an incident database of individuals or entities convicted of fraud. Then monitoring activities, because monitor distribution channel fraud trends and company performance audits that are sensitive to fraud, and keep an eye out for any fraud situation by tracking consumer complaints. As far as data analytics plays a crucial role to detect and prevent fraud, so they also maintain that this Insurance Information Bureau also maintain an industry-wide database of suspected fraud activities. So collaboration with insurers is required to ensure that data analysis effectively utilized. It is important to the insurers must participate in IIB's fraud monitoring system, use unique identifiers for policyholders to ensure data accuracy, and IIB will maintain a caution list of blacklisted entities like agents or hospitals. Thank you very much.